This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Well, back to business. China's top leaders will focus on spurring growth in 2023, seeking to revive the economy following 3 years of strict COVID curve, while Asian stocks start the week lower. Plus, breaking the deadlock, EU ministers meet to discuss a gas price cap that's almost a third lower than the original proposal. And the beautiful game, Argentina wins the World Cup after defeating France in a nail-biting final, a dramatic end to a controversial tournament for host Qatar. So we have plenty of stories that we want to get to, but first of all, let's get to the markets. Now you can see the VIX index, it's not that much or not as elevated as some market participants were saying it could be, gaining some 0.1%. The picture across the board for European stocks is still one of gains. Global stocks actually attempted this recovery from 2 weeks of losses, sparked by concern that the continued policy tightening, especially by the Fed in the U.S. and other central banks, would trigger an economic recession and therefore would hit companies' profits. For the moment, we're holding strong, gaining some 0.4%. The other story, of course, is the yield on U.S. Treasuries edging higher than yen. Look at yen, 135.90. We are expecting a hawkish pivot. We have a couple of guests that said, look, this will come, but it won't come tomorrow. We do have a BOJ decision. It could probably come as Kuroda steps down in April. We await to have more news about the agreement between the central bank and the government. The picture across the board, you can see the FTSE gaining some 0.4%, similar gains for the DAX and the CAC. Now, this is a picture for data coming out of the EU. I think we have German December IFO business confidence that's coming out, and that index is coming at 88.6 instead of the 87.5 figure, so it's a touch below estimates. Also, the prospect of further Fed rate hikes triggering a recession is fueling market caution. That's reduced investor appetite for riskier assets, which has sent equities actually lower in the long term. We're joined by Janet Moy, Head of Market Analysis at Brewin Dolphin, and our markets reporter, Justina Lee. So thank you both for joining us. Justina, talk us through what we'll see in terms of volatility as we head into 2023.
Yeah, I think for investors, there are really two big questions here. One is that, where is the Fed going next? And I think what we've heard from them last week is that they're very far from pivoting, if markets even expected that. And on the other hand, if we do kind of stay on this tightening path, what does that mean for economic growth? And specifically for equities, what does that mean for earnings? And so I think investors are really in a bind here, because it can feel like either of those outcomes, is probably not great for portfolios.
Yes, absolutely. Janet, is that your take as well? If you look at the constructive, when do markets actually start being constructive?
Hi, good morning, Francine. Thanks for having me. Yeah, we don't think that it is time to get bullish yet. We think that there's probably a buying opportunity for equities sometime in 2023. But we're warming up to bonds because, the Fed will keep hiking, but it is ultimately near the peak of that hiking cycle. And we think that the Fed will pause afterwards, and rate cut is probably a 2024 story. But after all, bonds look more attractive than equities because you've got yields available, which were not available, years ago. So as investors, we're warming up to bonds. We prefer sovereign bonds at this stage because of the recession risk next year. And so so that's why overall asset allocations that are preferring bonds over equities next year. But there will be a buying opportunity for equities next year.
So, Janet, is 2023 the year where actually equities and bonds will work in tandem like they used to in the past?
Yeah, so this year bonds haven't acted really as a portfolio diversifier, which is actually quite rare in history. So what we think is next year, as I said, we're warming up to bonds. We think that bonds will perform better, and primarily that's because we are seeing the peak in U.S. interest rates, and therefore we think that bond yields will peak and then fall next year. So bonds will act as a portfolio diversifier again. So we think that the bond equity correlation will weaken next year, which would be a good thing for investors.
Justina, how do you look at yen? I know there's a lot of talk. We've been promised a hawkish stance in the past, which we never got. Is this going to finally come to a head because we're almost at the end of the term for Governor Kuroda? I think he steps down in April.
Yeah, I think that's a great question. I mean, obviously, the Bank of Japan has never had to worry as much about inflation. And that's part of the reason why it's never had to kind of tighten as much as, other central banks have. And I think, another aspect to this is, what is going to happen to dollar strength? Because we did see a little bit more in that direction after that Fed meeting last week. But at the same time, if bond yields are peaking, as Janet mentioned, then maybe perhaps we're finally at the end of that cycle, because certainly by a lot of fundamental pressure, the dollar strength can look overstretched at this point.
So, Janet, what do you do with yen right now?
Yeah, so we think that this year the movement in yen has been pretty extreme, stretched, as Justina has mentioned, and we think that it has been years of this extremely loose monetary policy that the BOJ has been working at, and as developed market central banks have normalized, the BOJ is lagging, way lagging. So we think that there has to be a point, when things get that extreme and get overstressed, there has to be a point of reversal. And I think that could be sometime next year, as you mentioned, Francine, earlier, that could be a point where the BOJ governor steps down, and then we can see a bit more pivot in that BOJ policy towards a bit more hawkish tone.
Janet, the other thing that actually caught my eye in some of the things that you sent over is your appetite, I think, for gilts. So is this now the time to add gilts, and which part of the yield curve do you buy?
Yeah, so we are warming up to gilts. We actually have bought already during the mini budget volatility when gilt yields become very, very attractive. So now we're waiting for further opportunity. Because we think that gilts will perform better because, UK is facing a particularly bad economic situation. It is going to recession. And we think that basically investors are very underweight gilts at the moment. We think that there will be more inflows coming from investors. And we think that we are interested in the 7 to 10 year maturity of gilts. Mm-hmm. And overall speaking, we think that there will be better opportunity next year because the Bank of England is still hiking, but it is going to see headwinds in hiking further because of the UK economic situation, of the very weak housing market. So we think that we are approaching the point of peak gilt yields, but probably not at this moment right now, probably sometime early next year. We're watching very closely in the next 1 to 2 months.
Okay, thank you, Janet, for that. Justina, we also have quite a lot of data out of the U.S., including the University of Michigan, which I think it used to be one of the favorite indicators by some Fed officials. What are you expecting?
Yeah, I think we have a big week for U.S. economic data coming up. And I think it's going to be pretty important for investors because they've been on the lookout for, signs of slowdown. Because I think what we've seen so far is, the U.S. economy seems to have held up pretty well, but there is usually a lag effect from monetary tightening. And so the question here is, when do we start seeing these signs show up? And at the same time, that could also be a sign that inflation is indeed rolling over, but then there will now be a whole new set of concerns for investors.
Janet, what's your take on when you look at the Fed officials, but also where you expect the terminal rate? Will it peak at 5%, or do you think it'll go higher?
I mean, taking the face value of what the Fed officials are saying and the dot plot, I mean, Fed funds rate will go to over 5%, a little bit over 5%. I think it's not about the debate of the peak rate anymore. I think there's clear sign of economic weakness. There is, it takes time for that cumulated rate increase to take impacts on the economy and, on core inflation. So we think, 5 is probably about right. I think the debate is probably whether, the Fed will cut next year, which the market continue to be very optimistic on that. So we think that, rate cuts is probably a 2024 story. And as such, market too optimistic and probably it's not right now the time to buy equities or be bullish.
So, Janet, you're not expecting a rate cut next year. You're expecting what, early 2024 from the Fed?
Yeah, that's the case. Okay. Because we think that, ultimately, okay, the economy will go into recession, but it's going to be a mild recession. So the Fed will still be worried about the core inflation, which still, I mean, it's going down, but it's still way above target.
Okay, Janet, thanks so much. Janet Moy there, Head of Market Analysis at Brewin Dolphin, and Bloomberg's Justina Lee. Now, coming up, we'll have plenty more, of course, on energy. EU energy ministers attempt to break a deadlock over a proposed gas price cap. That as Germany opens its first LNG terminal. All of the latest on the EU's energy crisis next, and this is Bloomberg.
Germany is the engine of Europe, but what good's an engine without any gas?
We're here in the harbor of Wilhelmshaven. We're approaching the LNG tanker that has just arrived that will serve as the terminal to accept liquefied natural gas.
Germany is extremely dependent on natural gas for manufacturing, heating homes, generating electricity, and its chemical sector. It used to get more than half of it piped directly from Russia. This ship converts compressed LNG into gas, and it's a major step forward into filling that gap from Russia.
The ship has arrived from Spain carrying LNG from Nigeria, and the temperatures outside really underscore the degree of urgency here in Germany for natural gas.
They got this done in 10 months. The Chancellor inaugurated it this weekend, and the gas starts flowing. This facility alone can deliver more than 8% of Germany's consumption. 6 more like it are on the way, and that will provide infrastructure to cover a third of Germany's consumption. But that doesn't answer the big question. The infrastructure is necessary, but where will they get the actual LNG itself? With Russian taps turned off, it's a fiercely competitive market, and cargoes go to the highest bidder. Plus, if China reopens, you can have the world's second biggest economy back at the energy table with a big appetite. Oliver Crook, Bloomberg News, Wilhelmshaven, Germany.
Well, let's get more now on the energy situation with Oliver Crook in Wilhelmshaven and Maria Tadeo, who's at the EU Council building in Brussels. So, Maria, let's start with you. EU energy ministers meeting now in Brussels, where they're trying to break a deadlock over a proposal to cap gas prices. What's the latest?
Yes, Francine, and the meeting is now underway. All of the energy ministers of the European Union represented now underway having this meeting, and this is seen really as make or break. Today, it really is a last-ditch effort to get a deal done before the end of the year. And the pressure, Francine, it's immense because the clock is ticking. We have a few days left before the Christmas break. And of course, there's also the political pressure playing into this. European leaders on Thursday last week, when they met here in Brussels, they were very specific and very vocal. This back and forth over the price cap cannot continue. There needs to be a deal today. The price cap has been the biggest sticking point, but we should also stress that this is a comprehensive package that also includes things like joint purchases of gas. So this is Brussels. Nothing is agreed until everything is agreed, and they hope today, or at least the hope is that today will be the day.
So if it comes down to the price point for the price cap, what kind of figure could we actually agree on?
And Francine, bottom line, that is the situation. It comes down to that number because we have been told repeatedly 90% of this package, of this comprehensive market intervention for energy is done. The issue is the price cap. Now, to take everyone back, remember the European Commission came out with an initial proposal set at 275 euros megawatt hour for 2 weeks before this price cap would be triggered. That was seen as too high and not aggressive enough. That number now has been brought down by the Czech presidency, which holds the rotating presidency of the European Union, to 188 euros megawatt hour for 3 days. So the range is big. We have seen significant moves. The question is whether 188 will do the trick for this deal to finally go through the finish line.
Thank you, Maria. Let's also get straight to Oliver Crook. Oliver, what's the situation? I mean, that's the situation in Brussels. There are, of course, direct linkages to where you are. And what are those implications, of course, for Germany?
So the debate in Brussels actually creates a lot of angst here in Germany. As you can see from the ship behind me, the virtue of this ship is that it can accept cargoes from all over the planet, and which is a great thing when you're trying to cut your dependence from Russian gas. However, by that same token, those ships can be rerouted with just a single phone call. So if that cap comes in too low for Germany, the fear is that they will be outbid for what is already an extremely tight market for LNG and a very competitive one. Germany is more dependent on gas than many of its new European neighbors. Plus, it has deep pockets and is willing to spend for that gas. So all of this is creating a lot of anxiety here in Germany, and that is really why they've stood in opposition and been very, very cautious towards any conversation on the gas price cap.
Ollie, thank you so much. Bloomberg's Oliver Crook there in Wilhelmshaven in Germany and Maria Tadeo in Brussels. Now, coming up, we'll also talk to the UK's Shadow Work and Pension Secretary, Jonathan Ashworth. We'll discuss the state of the UK economy, including the barrage of strikes seen this year alone. That's coming up shortly, and this is Bloomberg.
We have clear signs that demand exceeds supply in our economy and our labor market.
We're going to go until the job is well and truly done, which is 2% on average inflation.
We're going to have to do what's necessary, again, sufficiently restrictive to bring inflation down.
We're going to have to move rates up, ongoing increases from the current rate to above 5% and hold there for some time in order to get inflation back down to 2%. And that's what we're about doing right now.
Fed officials reiterating the need for higher rates there. Of course, we'll have a full roundup of what markets are expecting. We do have some important data points a little bit later on this week in the U.S., including that Michigan sentiment that is on Friday. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Francine, good morning and thank you. Media reports say the number of COVID deaths in Beijing's funeral homes is surging, raising concerns that China is hiding data on the latest wave of the virus. Staff at a local crematorium told the Financial Times they'd seen at least 30 COVID victims. The country of 1.4 billion people says just 11 people have died with the virus over the past month. Now, the EU has reached an agreement to expand its flagship carbon market, extending emissions trading to heating, road transport and shipping. Under a provisional deal, the bloc will also accelerate the pace at which some companies are obligated to reduce pollution. Separately, the UK has signed an agreement with the group, including the European Commission, to develop offshore renewable energy projects in the North Sea. Zambia's president says the nation is trying to reach sustainable debt levels without damaging key components of the economy or, quote, rocking the boat. In an interview with Bloomberg TV, he encouraged creditors to reach an agreement as quickly as possible.
We certainly expect progress because that's the way it should be, because there's an understanding that the process will run to a point like where we are now, where we can quickly and work through towards signing a memorandum of understanding. And for us to do that, we have to make progress on the issues around what is the quantum of debt that is sustainable.
Messi has finally added the World Cup to his trophy list as Argentina beat France in a gripping World Cup final. Argentina let a 2-goal lead slip late in the second half, with Messi and Mbappe each going on to score in extra time to make it 3-3. The 4-2 penalty shootout brought France's hopes of retaining the cup to an end, returning it to South America after 36 years of absence. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, these are some of the movers in today's trading session. So we look at individual stocks. First of all, Porsche actually joining Germany's main equity benchmark. This is as they replace the sporting goods maker Puma. Now, Porsche has more or less a market value of around 96 billion euros. It did become Europe's most valuable automaker this year when its market cap even overtook that of the parent company Volkswagen just a few days after the initial public offering in late September. The picture for Porsche today gaining some 4.3%. The other story we're watching out for, and of course this is related to the World Cup, because we need to talk about the World Cup and Lionel Messi as much as we can. Wow, what a final. A lot of people tweeting saying, I wish I could watch it back. It was so good. Adidas scrambling to keep up with demand for jerseys featuring the Argentine football star Lionel Messi. That was ahead of the FIFA World Cup final. So I just imagine what the story is like today. And then the other story that we're watching out for is, of course, AstraZeneca. Now, the pharmaceutical giant's drug, Imfinzi, we understand did not achieve a statistically significant overall survival compared to chemotherapy in a key phase 3 trial on patients with lung cancer. And so we're seeing a bit of pressure for AstraZeneca. And of course, a lot of disappointment, I imagine, from a lot of people that are sick right now. But AstraZeneca down 0.4%. So overall, market indices holding strong, gaining some 0.5%. The big story, of course, is what's happening in Japan with the possible hawkish tilt from the Bank of Japan. So we'll have plenty more, of course, on the market action throughout the day. Coming up, we also focus on the UK. The market's cautious as the Fed maintains its hawkish rates outlook. We'll have plenty more on that shortly. And this is Bloomberg. Welcome back. Now, these are your top stories today. We, of course, focus on the markets. The markets left, right, and center as we also await for some data out of the U.S. Back to business. China's top leaders will focus on spurring growth in 2023, seeking to revive the economy following 3 years of strict COVID curbs. Asian stocks start the week lower. Breaking the deadlock, EU ministers meet to discuss a gas price cap that's almost a third lower than an original proposal. Plus, the beautiful game, Argentina wins the World Cup after defeating France in a nail-biting final, a dramatic end to a controversial tournament for host Qatar. Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the prospect of further Fed rate hikes triggering a recession is fueling market caution. The dollar fell as investors cut long bets while weighing the Fed's outlook on monetary policy. Well, we're joined by Hannah Smith, Vice President for State Street's ETF business. Hannah, thank you so much for joining us. I mean, we thought that there'd be a bit of a risk reversal, but actually, could we get a Santa rally? If you look at European stocks, they're gaining in today's trading session.
Yeah, definitely. I think there's now some more reassurance that we may have reached peak rates. And so we saw actually last week in the ETF space, we saw 1 billion going into European fixed income. So there's definitely appetite within the space there. And also within emerging markets, we're also seeing appetite there, 750 million inflows into the space. So investors are definitely have a bit more risk appetite. Yeah,
I mean, what do you expect for 2023? Of course, what we saw in the last couple of weeks was a lot of risk aversion because if central banks hike, then it pushes in a recession, which will hurt corporate profits.
Yeah, I think in 2023, we're expecting peak rates to have been reached in most of the developed markets. And then I think that will give us a bit more clarity. Obviously, also the story around China reopening has been quite positive. And so we have seen flows now into emerging markets. I think the catalyst we were waiting for was China reopening and also peak rates. So now we are seeing a greater appetite of investors to maybe take on more risk within their portfolios.
Hannah, is 2023 the year where we're going to see equities move in tandem with bonds?
Well, it's an interesting question. Obviously, 2022 has been unprecedented in terms of the correlation that we've seen with fixed income and equities. But equities are still very expensive. If we look at the PE ratios on the S&P, it's around 17.5, which is above the 20-year highs that we've seen. And so when we're looking at opportunities, equities at the moment aren't screaming great value.
Is there anywhere in the world where they scream, if not great value, some value?
I think emerging markets, their valuations are very attractive, as they have been for some time. And what we're now seeing is that, as I mentioned earlier, with this China reopening, it provides further support. So we are seeing investors want to go back in. If we look at the returns last month within emerging markets, it was 12% just within that 1 month, and that's 5 times more than the US and two times more than Europe. So there's definitely opportunity there.
And so, Hannah, in terms of your base case, what happens to dollar? I think I've rarely seen it this split on what market participants say.
Yeah, dollar's interesting interesting. I think we saw it peak in September. It was the highest level since 2002, but since then it's dropped 9%. So when you look at the dollar, I think that some of the support mechanisms that were holding it up, such as higher rates versus the other economies, as well as China, concerns around China, and also the growth dynamics were really supportive of the dollar. It's likely that we're going to see those come off now within 2023. So I think we'll see kind of less strength supporting the currency.
Okay, we're like Jules Verne. We're going around the world in like 60 seconds. What happens to the UK next year? I mean, we're seeing, so, there's a month of misery with strikes. We're not 100% sure how we settled on pay. What does it take for investors to come back into certain parts of UK assets?
Yeah, I think the UK is really interesting because the stock market is quite dislocated from what goes on within the economy. And so what we see within the UK is it has high exposure to energy, which has obviously performed relatively well given the supply chain constraints. In addition, it's very defensive. We have high exposure to consumer staples. Also, a lot of companies generate their revenues overseas, so a falling sterling is beneficial. So we have seen it perform relatively well, but as I mentioned, that's not necessarily a reflection of what we're seeing going on within the wider UK economy.
I mean, are there any ETF flows into some of the smaller companies? I guess you make a difference between the FTSE 100 and 250, which is much more exposed to domestic issues.
Yeah, definitely. So I think the flows into UK have been quite mixed. I think for the smaller companies, they are a little bit more exposed to what we're seeing within the UK economy. So those flows haven't been as strong as what we've seen in the FTSE 100, for example.
Okay, Yen, I mean, we've been promised a hawkish BOJ for such a long time. Many participants are not believing it, but we're also coming to almost to the end of the Kuroda era.
Yeah, I think Japan, actually, if we look at Japan as a whole, it's actually performed really well. And we're now seeing profit-taking within Japanese equities. Obviously, the weaker yen had actually been supportive because a lot of companies generate their revenues overseas. I think 47% of revenues come overseas. So it will be interesting to see how that plays out now that we may not see such a weak yen within the market.
I mean, I've heard this before, that actually yen and the BOJ could be the big story of 2023. But does it have a read across for other nations that either border it or certainly do a lot of trade with it?
I think that when we look at Japan, I think it has been underrated for quite a long time. Japan is always the place which looks undervalued and underowned, and so we have always been quite positive on Japan just because the valuations are attractive, the weak yen has been supportive. But I think it will be interesting to see now how that plays out, and it does feel that investors are starting to like it. We have seen some flows, so I think it's one to watch in 2023 as to how that plays out.
Hannah, I know we mentioned also the Fed, but are there any leading indicators that you're watching out for? I know we have University of Michigan on Friday, which I think used to be one of Jay Powell's favorite indicators. But now we have housing. Is there danger that actually the terminal rate that we're expecting for the Fed, which is around 5.25, could shift significantly?
Yeah, I think that's the biggest concern for investors right now. Obviously, we saw weaker inflation data come out of the US, which was positive for the market, as there had been a dislocation so long between expectations and the data that we were seeing. But I think 2023, we're really expecting that we are going to see peak rates, and that is obviously a result of inflation coming under control. So I think it's obviously a leading indicator for the rest of the world, what we see in terms of inflation coming out of the US. And we do expect that will start to turn positive in terms of that connection between the data that we're expecting and also rates that we see from the central banks.
Did you watch the football final yesterday?
Of course.
I mean, commiserations, first of all, to my husband, who's half French, and he will need like 2 weeks to get over it. Yeah. It's amazing when you look at first of all, it was an incredible, incredible game. Then you look at, fundamentals in Argentina. I mean, 100% inflation. Like, is there any, read across for...
I don't know. I think it's a great question, and I did see a lot of conversations around the back of that. But I guess maybe now there'll be a bigger focus given the World Cup and people looking at what the policies may be.
Hannah, thank you so much. Hannah Smith, their Vice President for State Street's ETF business, and thank you also for all of your interviews this year. We'll see you in 2023. Now we're just getting some breaking news out of South Africa. The ruling party, the ANC, has re-elected Cyril Ramaphosa as party president. Now, we also look at Rand. Our Valerie Teitel, of course, our markets editor, has her eye on exactly what's happening to Rand, strengthening, I think, some 2.5% on Mr. Ramaphosa being re-elected as ANC president. Coming up, the UK braces for the most disruptive week of strikes yet. Don't miss our exclusive interview with Jonathan Ashworth. He's the UK's Shadow Work and Pension Secretary. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now it's focused on the UK, and of course Britain's bracing for the most disruptive week of industrial action yet. Nurses, ambulance workers, postal staff and border guards are all striking this week, with millions of people's Christmas travel plans set to be thrown into disarray by another round of railway walkouts. It adds to the headache for the UK labour market, which has lost more than 500,000 people since the start of the pandemic. Well, joining us now is Bloomberg's UK correspondent Lizzie Burden, and we're also joined by a great guest. But Lizzie, I mean, the problem is basically the missing workers.
It is, and this is really the big question mark in the UK economy. It's consequential because employers are having to dangle bigger wage packets to bring in the staff. That's pushing into the double-digit inflation, but workers aren't benefiting from the pay growth. Now, there's been a list of reasons suggested for why these workers are missing: pandemic savings, long COVID, NHS backlogs, and a new reason was suggested by the Treasury Select Committee last week in a cross-party report. They said that because all the cost of living benefits were rushed out, inadvertently they might be disincentivising work. Now, the Work and Pension Secretary Mel Stride is looking into this in his Stride review on labour market inactivity. I want to know what the opposition Labour Party's view is on this. So we're joined now by Jonathan Ashworth, Labour's Shadow Work and Pension Secretary. Jonathan, thanks so much for being with us. What I really want to know is, do you agree with the Treasury Select Committee Chair Harriet Baldwin that there are people who can work but are choosing not to?
There are definitely more people in this country who can work. We've got employment at a lower level than it was pre-pandemic, and I think out of the G7 countries, we're one of the few to have regained our pre-pandemic employment rates. And when you drill down into the data, we've got 2.5 million out of work for reasons of long-term sickness. That's a 20-year high in the United Kingdom. We've got this great silver exodus, if you like, of the over 50s who have left the labour market, and of some of the people who are short-term unemployed, looking for work on universal credit. Because the Treasury Select Committee is correct in as much as there'll be some who are getting the cost of living payment, yet if they go £1 over the threshold, they'll lose a significant amount because of the cost of living payment. But that is a temporary phenomenon, because the cost of living payments will not last forever. What are some of the more significant barriers to moving into work are the huge costs of childcare in this country, housing costs, transport links, but also our employment support regime through our job centres is not giving people the coaching, the retraining opportunities, the detailed personalised support that it really needs to do. And that is something that I am focused on, and I want to reform the system.
Well, economists say that one of the reasons for labour market inactivity in the UK is Brexit. Your leader says that he wants to be the party of business, that Labour's all about growth. Would you have softer ties on EU migration?
No, we're not proposing to change that. We would have a points-based system for immigration. But look at the data. There's 1.7 million people who say they are inactive, but who would want to go back to work, according to the ONS survey. Plus, we've got 1.2 million people short-term unemployed. So that's a pool of 3 million people who want to work in this country but are not getting the right levels of support to return to the labour market. We've got to change that.
It's unclear to me, actually, why that is. Is this long-term sickness because it's NHS waiting lists?
Yeah.
Is this because it's long COVID? And actually, will the cost of living crisis entice people back sooner than maybe they should?
Well, that's a really great question. So when you drill down into the data, there is no question that the 7 million on the waiting list, the 400,000 waiting beyond a year for treatment, whether that's a knee operation, a shoulder operation, that is definitely pushing some of the over 50s out of the labour market. A growing burden of it is also mental health conditions and people not able to get the right levels of support. But here's the thing. There have been pilot projects across the country where we've put employment advisors in mental health services, and it's actually helped people return to work. And one of the things that I would do if I was the Secretary of State is that rather than trying to fix all this from behind my desk in Whitehall, I would devolve budgets to local areas and ask local areas to work closely with the NHS, work closely with local services to give people support.
Would you give nurses a pay rise?
Well,
that most people say they
we've got to negotiate, or the government has to negotiate with nurses. The nurses, look, the strikes, the industrial action we're seeing in the United Kingdom is a symptom of 12 years of mediocre growth, of failing to make our economy more productive. It's why wages have been squeezed. People who actually were better off in real terms under the last Labour government, which we weren't in government since 2010. So these symptoms are a reflection of that. We've now got inflation running at 10%, which means the cost of everything is going up, as you know. And that's why nurses are taking industrial action. But it's incumbent upon Rishi Sunak and his team of ministers to negotiate with those NHS staff to find a resolution, because we don't want to see these strikes go ahead this week.
Well, so it's not just the silver exodus of older people leaving the workforce, it's also 16 to 35-year-olds. We're in a cost of living crisis. What bigger incentive could you possibly have to get into work other than the need to survive?
Well, I mean, I think being in work is important anyway. It's important for your sense of well-being. I think it's important for your contribution that you can make to society and the sense of inclusiveness in society. But it's got to be in your economic interests as well. And for many, it isn't. And that's because wages have been squeezed. It's because things like childcare is so expensive. Many people find that they would be worse off because of childcare costs. That is absolute madness. But there's also people who can't return to work because they have caring responsibilities beyond children. Many of these over 50s are now caring for a partner or a mum or a dad who've got Alzheimer's or had a stroke. And if they had flexible work options, they would return to work.
But how do you square that circle? So if it's childcare that you need, do you not need to increase immigration so that you have some kind of, child support system?
Well, we need to increase childcare provision. So one of the policies that Labour have announced is that we would open breakfast clubs across the country so parents can drop their children off at 8 o'clock and then get to work. We don't have a cohesive childcare service in this country. In fact, and the costs of childcare, for some people, childcare costs more than rent. That's absolute madness, and it prohibits people from returning to the labour market.
Jonathan, just going back to the strikes, if I'm a public sector worker, if I'm a nurse, and Labour, the party of unions, supposedly won't commit to an inflation-busting pay rise, what's the point of voting for you?
Because we want to negotiate with NHS staff, and we've got nothing but praise for staff. I mean, they got us through our darkest days since the war, but we would negotiate, and we would give a fair pay settlement to NHS staff through negotiation. But we'd do other things as well. No, NHS staff have been working with their fingers to the bone. They're absolutely exhausted because there's so few of them. We're short of around 40,000 nurses and midwives. So one of the things that we have said we would do is get rid of the non-dom tax status and use the proceeds from that tax change to expand places so we've got more nurses, more midwives, more paramedics in the NHS.
Yeah, but on the pay, would you give them what they're asking for?
No, but we would negotiate. I mean, we've said, Wes Streeting, our Shadow Health Secretary, said 19% is unaffordable, but we would sit down and have a serious negotiation. Negotiation.
But inflation, I understand, but inflation is so high, right? And we talk about this every day. At some point, if they ask for an increase, leave everything else to one side, would you give them that money?
We would negotiate. It has to be through negotiation. And negotiation just isn't about pay rates. It's also about terms and conditions. It's also about safe staffing arrangements. So these are the things that should be brought to the table, and we would engage in a meaningful negotiation on those fronts.
All right, Jonathan Ashworth, thank you so much to the UK's Shadow Work and Pension Secretary, and of course, thank you to Lizzie Burden, who brought us this great interview. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Sam Bankman-Fried is said to be planning to drop his fight against extradition to the US. Sources tell Bloomberg that the disgraced FTX co-founder is expected to tell a court this week that he won't fight the request. He's currently being held in a prison in the Bahamas. He denies knowingly committing fraud or breaking the law. Elon Musk is asking users whether he should step down from running Twitter. With 2 hours left and some 15 million votes cast, 57% of participants in the online vote have so far said that he should. The billionaire owner of Twitter says he will abide by the results of the poll. Over the past week, Musk has come under fire for banning multiple accounts, including those of some prominent journalists. China's top leaders say they plan to focus on boosting the economy economy next year, hinting at business-friendly policies. At the Central Economic Work Conference, she and other senior officials pledged to revive consumption and support the private sector, and marked a shift from recent years. Economists say policymakers are likely to target GDP growth of at least 5% in 2023. Intel will reportedly delay construction of its planned German chip plant in a blow to Europe's semiconductor ambitions. Local media reports that Intel is seeking more government subsidies as costs for the mega plant in Magdeburg have jumped to 20 billion euros. The chipmaker says much has changed since first announcing plans for the plant, which was actually earlier this year. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Coming up, Magic Messi. We discuss Argentina's win at the World Cup final and what the tournament means for host nation Qatar. That's coming up next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we're just getting some breaking news out of South Africa. South Africa's ANC ruling party has re-elected Cyril Ramaphosa as party president. It's also elected Mr. Mashatile as a party deputy president. Of course, he was on this very program just 2 weeks ago supporting President Ramaphosa. On to other things, and Qatar. Lionel Messi has finally added the World Cup to his trophy list after Argentina beat France on penalties in one of the greatest finals in the tournament's history. Now, joining us now is Bloomberg's Simone Foxman in Doha. Simone, you were at the final. I can't even begin to imagine the level of excitement that was in the stadium. What was it like?
It was really thrilling, Francine. It was certainly my first World Cup final, and everyone on the edge of their seat when France was coming back and looked like it would make up that 2-0 deficit, and then going into extra time and finally penalty kicks. The vast majority of the fans were Argentine supporters. They were very loud through the duration of the tournament, and many of them were wearing that blue and white shirt manufactured by Adidas, for which the company says it is in very low stock around the world.
So you wrote this morning that this World Cup stands the risk of turning Doha into the Gulf's, well, one of the most conspicuous white elephants. What do you mean by that?
Well, the country has invested more than $300 billion, according to Bloomberg intelligence analysts, in trying to build infrastructure, a new metro system, expanding its airport and the like, to try and boost the non-oil economy. But what the concern is now is that there were already residential and office buildings that were empty ahead of this World Cup. There are going to be 14,000 to 15,000 new hotel rooms in the market, and occupancy rates were sitting below 60%. So what a lot of the analysts and investors that I've spoken to say is the government is going to need to do something. Either they're going to need to put more money into the non-oil economy, or they're going to need to change their laws in order to try and encourage tourists, businesses to come here on a more regular basis, to try and bring more people here, because otherwise the population is going to decline. And, money alone is not enough to get people in hotel rooms, in buildings, and running their businesses from Qatar.
Thank you so much. Of course, that was our Simone Foxman in Doha. Now, that is it for the Bloomberg Surveillance Early Edition. We have Anna Edwards in New York, Danny Berger in London. They'll have a full roundup of what exactly is going on in the markets. This is Bloomberg.
Right now, we're trying to move our policy in the way to get back to price stability, but in a way that minimizes the pain of the journey.
We're going to go until the job is well and truly done, which is 2% on average inflation.
I am getting increasingly confident that we're getting closer to that point, but obviously we have to watch the data.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Coping with COVID, China looks to jumpstart an economy battered by COVID-0 restrictions. Meanwhile, there's suspicion that Beijing is hiding the real number of deaths from the latest outbreak. Millions respond after Elon Musk asked Twitter users whether he should step down as CEO. Most of them say he should. And euphoria in Argentina, a country battered by sky-high inflation and political uncertainty, celebrates a World Cup victory for the ages. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Anna Edwards in New York this week. Both Matt Miller and Kailey Leinz will be hosting the U.S. Close show later today, so they are off. Anna, there's some wonderful irony to the fact that I, the American, am still here in London, and you've traveled to New York, to the land of soccer. But maybe this just means you and I will be less distracted by football this morning.
Yeah, just maybe, Danny. Very good to see you here from New York. Yeah, I'm here for some pre-holiday cheer. I think that's the reason I'm going with for my visit. Danny, let's have a look at what's been going on through the Asia session then and into the US session, set you up for the trading day ahead. This is what we see through Asia. MSCI Asia Pacific under some pressure. Cautious trading through the Asia session, down by 0.2%. We have the Chinese equity market here, the CSI 300, down 1.5%. We've got a renewed focus on the economy from the Chinese, that economic conference taking place over the weekend, but that not enough to counter the gloom and concern around COVID cases rising and possibly death counts as well. So that particular index down by 1.5%. Then we come to the Japanese assets, Danny. We've got the Japanese 5-year yield in here. We have the yield going higher, and the yen has been actually quite volatile in this morning's session as we've been pricing in the ebb and flow of a particular story around the yield curve in Japan and the BOJ, the relationship between the government and monetary policy. Will there be more flexibility from the government for monetary policy to be conducted differently? Does that mean any kind of step away from yield curve control? That's what the market was assuming after it saw reports that suggested that, but then government officials pouring a little bit of cold water on those reports, but we've still seen quite a bit of movement in Japanese assets in the meantime. Let's have a look at where we are on the US picture then. US futures point a little higher, but this after a lot of focus on negativity last week, and this despite the fact that we got that inflation print out of the US coming in better than had been anticipated, running lower on inflation, but still the Fed story dominates, the ECB story, the global central banking story dominates, and that put pressure on equities at the end of last week. We looked to bounce a little bit on that this morning, up by 0.3%. Still a few hours to go until the start of US trade, of course. This is the yield on the US 10-year. Will it be a year for bonds next year? We'll get into that conversation a little bit later on. Given if we are going to be dominated by recession fears, how good might that be for fixed income? This is the WTI price, $74.90. A focus on the SPR, the US wanting to refill the Strategic Petroleum Reserve. That's part of the conversation. Also a focus on the Chinese growth narrative as well. And we've got the Binance coin in here, Danny. Normally Matt talks about Bitcoin, but we put the Binance coin in because there's been some reporting over the last few days that perhaps this coin bouncing a little bit, and maybe that underscores a little bit of reprieve for the crypto sector after the drama that, of course, we saw on FTX. Danny, what do you see on the Europe story this morning?
I got to say, it's similar to what you saw in American stocks, Anna, but I'm just not sure how much we can really trust this rally, how much we can read into it. Essentially, every single index in Western Europe is heading higher this morning. Nearly every sector is also moving higher. It's led by energy. Should be no surprise considering, Anna, that oil price you were just showing. Energy stocks moving higher by about 2.5%. But again, it is the end of the year. There's often weird rebalancing things happening at the end of the year. And last week was just so negative, the worst week for European stocks since November, after that very hawkish Christine Lagarde and the rest of the ECB. So on a headline basis, we're up about 0.5% for the Euro Stoxx 600, and yields are moving even higher in Europe than they are in the US. It is a clear underperformance that started with the ECB meeting last week and continues today. German 10-year yields, those are up by 4 basis points. On the front end of the curve, German yields are the highest since 2008. Now, that shrinking differential between European bonds and U.S. bond yields means that we're getting support to the euro generally. It's a down day for the dollar, but the euro versus the dollar is appreciating about 0.4%. We're currently at 106.26. The other currency to track is the South African rand. That's also advancing against the dollar. This is not just a dollar week story where the dollar is declining by about 2.33%. The ANC has re-elected Cyril Ramaphosa to head their party. They're, of course, the ruling party currently of South Africa. There was a lot of concern about whether Cyril Ramaphosa would stay around, considering there was this scandal about the theft of stolen money in a couch. A very odd story, but investors might be comforted by the fact, Anna, that Cyril Ramaphosa, at least for now, is sticking around and can continue to chase his reforms.
OK, we'll certainly focus in on that. Let's get back to the Chinese growth story then, Danny. Starting in China, the government says it will focus on boosting the economy next year. At the Communist Party's annual Central Economic Work Conference, China's President Xi Jinping and other senior officials hinted at business-friendly policies and further support for the property market, while likely scaling back fiscal stimulus. Bloomberg's James Mager joins us now in Beijing for more. And let's focus on the things we've heard from the work conference then, James, and a focus on the economy. How substantial is this?
Yeah, the Chinese economy did not do well this year. Exports are now falling. Domestic consumption is very weak. The property market has slumped now for more than 15 months. And so this renewed focus on the domestic economy is really what is needed. The government is saying that they're looking to boost private spending. They're looking to obviously help housing developers and help the housing market. And they're also looking to pull back on some of the over-regulation of the tech sector, which had really damaged not only the value of the tech companies, but also a lot of those companies are shedding jobs. So these are sort of the sounds, or these are the sort of the comments that people were looking for from the conference on the policies going forward next year, or what they could hope to see when the actual details of those policies are announced in March. I mean, the question now is, how effective is that going to be? Can the government really boost private consumption without massive injections of income support for Chinese people who've seen their incomes damaged quite substantially over the last few years because of the lockdowns, because of the slump in various the services sector and other parts of the economy. It's unclear whether the government can turn that around quickly in 2023.
James, there also seems to be some skepticism about numbers of COVID in China, be it cases or deaths themselves. China still hasn't recorded a death from COVID since December 4th, despite reports of hospitals filling up. How should we be thinking about these figures from these COVID reports coming from China?
Well, that's changed a little bit. They reported 2 whole deaths over the weekend, which just underscores the point you're making, that the numbers that they're reporting about cases and the numbers they're reporting about deaths are completely out of proportion to where they should be, considering the size of the outbreak. Obviously, cases, it relies on testing. China is no longer testing like it was, and that's what happened in many other countries. As people move from PCR testing to the rapid antigen tests, they don't report those, and so testing numbers, case numbers, obviously have no relation to the outbreak. But we should be seeing hundreds of deaths now, considering the numbers of cases that are happening in Beijing and other cities, and that's just not the case. Now, whether that's a concerted effort by the government to downplay and cover up those deaths so that people aren't afraid of the outbreak, whether that's doctors who are overwhelmed and are just putting down pneumonia on a death certificate instead of assigning it to COVID, or what the reason for that is, the numbers that you're seeing out of China on the very, very limited numbers of deaths are just unbelievable. If you look at the population of Australia, it's about the same size as Beijing. And when Australia reopened from COVID-0 in 2021, you saw hundreds of deaths a day at some point. Whereas, as I just said, you saw 2 deaths over the weekend. You've only had 2 deaths in Beijing in the last 3 weeks. That's just unbelievable.
Okay, James, thank you very much. That's Bloomberg's James Mager reporting from Beijing. Now, from China, let's talk about the tech story. And Elon Musk is asking Twitter users whether he should step down as CEO of the social media site. Millions of votes have been cast in the poll. About 57% of those so far say Musk should quit. He's been under fire for a number of policy changes at Twitter. Alex Webb of Bloomberg Quick Take joins us now for more. And of course, Alex, he followed up that poll by basically saying no one wants the job who can actually keep Twitter alive. Well, what's the actual likelihood that Musk would step down?
I think if he says he's going to, it seems there's a good chance he will. He's been made lots of comments like, be careful what you wish for. I suspect that it's not the whole story. Don't forget, this follows off the back of several things that happened last week. Firstly, Tesla had its worst week in I think 2-3 years. It lost, just in the course of the week, 16% of its market capitalization. He's at the same time seeking new investors in Twitter. So you wonder whether there's some, this is all speculation, of course, there's some external pressures here, whether the independent directors, such as independent as they are, at Tesla are sort of saying, please don't be as distracted as you are right now. Secondly, whether he's going out seeking new investors and those investors are saying, we will not invest in it if you are CEO.
Or perhaps the Qataris, where he was over the weekend.
It's a distinct possibility. He was in Qatar, photographed in a box at the football World Cup final with Jared Kushner, interestingly enough. So lots of conversations, presumably, that he's having with other people. It has happened in the past where he has put stuff out to a poll and then it's subsequently been reported that this was already a decision he had taken.
Yeah, it does seem an incredible way to run a business, to ask Twitter followers to decide these things, really, doesn't it? I mean, in terms of normal business practice. Do you get a sense then this is really about Tesla, Alex, and the fact that he's been so distracted by other things, and we've all seen what's happened to Tesla's share price?
I mean, I don't think it's any one factor. That is probably one of a raft of other factors. Tesla is down significantly since he took over at Twitter, I think in the order of 40%, while the market remains broadly flat. That is, of course, the source of, the majority of his wealth. So any troubles that Tesla has subsequently will affect his ability to continue funding Twitter if, the value of his equity stake there is diminished. So, it is a big consideration. Don't forget, though, Twitter is losing a huge number of advertisers. One has to wonder whether, therefore, others who invest in Twitter, because he might in name be the owner, but there are plenty of other interested parties there, whether they're starting to ask these questions too.
And you just wonder whether other businesses that maybe haven't decided they'll quit their advertising platform, how they would view such a move to ask Twitter users whether the boss should resign. Seems quite incredible. Bloomberg's Alex Webb, thank you very much for the update on the Twitter story. Now, World Cup fever is over, at least for another 4 years. Lionel Messi finally adding the World Cup to his trophy list. It's a long trophy list, of course. Argentina beat France on penalties in one of the greatest finals in the tournament's history. Joining us now is Simone Foxman in Doha. Well, it certainly wasn't boring, Simone. I saw Argentina fans and France fans out in force here in New York yesterday. You were at the final itself. You were there on the ground. What was the atmosphere like?
I was, and it was thrilling. However, here there were mostly Argentina fans. They seemed like they were everywhere, the blue and white. And there were just a small contingent of French fans that came out after we saw Mbappe even up the score really at the end of regular time. And they continued to be there into extra time. But it was absolutely thrilling. We couldn't see which way things would go. And of course, Qatar couldn't have asked for a better spectacle to end this World Cup, which has had thrilling upsets. A lot of teams come through that weren't necessarily expected to do so well. So certainly lots of fans cheering as they exited the stadium yesterday.
I got to say, it's pretty impressive, all the Argentina fans there, considering I don't think you can get to Doha directly, and it's got to be more than double the time it takes to fly there than it would from France. Look, Simone, this has been a World Cup that has been mired in lots of controversy. It ends on a high note here with the very captivating final match. What will the legacy of this World Cup be?
Well, one of the interesting ways we're going to determine this legacy is whether or not the $300 billion in investments that Qatar has made into building infrastructure, whether it be a new metro system or expanding its airport, whether those $300 billion are going to truly kickstart the next phase of its non-oil economic growth. Yes, it gets a lot of money from LNG, and it's going to continue to do so, but can it continue to bring businesses and tourists here? From our reporting, that's not so clear. That said, for the rest of the world and fans elsewhere, outside of those traditional pockets of real football stalwarts in Northern Europe or in Latin America, certainly the Arab viewers, the African viewers, even the U.S. viewers, which were out in force, have become a lot more important to this World Cup story. That's something that's likely to benefit Fox Sports, which saw some record viewers for certain of its games. And then finally, the point I want to make, as you referred to controversies, Danny, is human rights activists not necessarily unhappy with the way things went over the last couple of weeks, with the focus really back on the pitch. They hope that this is a baseline for future criticism around human rights and other sporting events and social issues, and that we're just going to see more of that in sporting events, including the World Cup going forward.
Yeah, it's certainly shone a spotlight, hasn't it, Simone? Thank you very much. Thanks to Simone Foxman with her coverage of many angles on that World Cup story in the last few weeks. Now we'll look at some of the stocks that are moving pre-market in the United States. So ahead of the session, Tesla on the move, up by 4.7%. Here's the link between Twitter and Tesla, of course, as Twitter CEO Elon Musk polls Twitter users, asks them, should he stay on as CEO? Well, what does that do to investors in Tesla? Well, it looks as if they're a little more optimistic that they might get the attention of the big guy, because that stock up by 4.7%. Novavax, the biotech business, is in focus as well. The company receiving an expanded recommendation for COVID-19 vaccines in Germany. The stock up 1.6%, but that in the context of some heavy selling just last week, where we got a capital hike from the business and also a UK vaccine supply cut. Onto Amazon, that's another pre-market mover. Amazon hit with strike campaigns in Germany days before Christmas. The Verdi union over in Germany calling on its members to take strike action. Of course, this is an increasingly, Danny, unionized business in various parts of the world.
Yeah, and just really in general, more of Europe facing strikes. The UK, of course, facing strikes, potentially in ground traffic controllers as well around the holiday season. Anna, I hope you're able to get home. All right, but first, coming up on the program, we're going to be speaking with Ben Gutteridge, Invesco Director of Model Portfolio Services, about a very tough end to the year and what he sees coming for 2023. We're also going to talk crypto. Tim Grant is joining, Head of EMEA at Galaxy Digital, plus a bruising blow to San Francisco, how tech layoffs and remote work are colliding to reshape the future of the city. Read more of today's big take online or on the Bloomberg terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Anna Edwards in New York. Now, it has been a strange end to this year, and what some had hoped might be a Santa rally, it has really not come to fruition at all. Now, I want to show you a chart for radio listening audiences. It is an extremely simple one. It is about 2 years worth of the S&P 500 with a resistance line. And this is an index which has really struggled to break above it. It might have rallied through September into December, but so far this month, it has been falling. Now, does this portend anything for 2023? Joining us to help answer that is Simon White, Bloomberg macro strategist. And Simon, I know the end of the year, a lot of weird stuff goes on, a lot of rebalancing, what have you. But is it telling at all that stocks have struggled to hold on to any rally, be it bear market rally otherwise?
Yeah, I mean, I think there's a number of really formidable headwinds that stocks have to face. Now, this quarter is actually okay. We're up 7% in the quarter. Seasonally, the last quarter is often the best, but obviously the 3 quarters preceding that were terrible for stocks. I don't think it sets a precedent for next year. You've got 3 kind of major headwinds. You've got continuing slowdown in global growth. That's very bad for US earnings. You have continued people coming out of stocks and going into cash. So if you look at stock allocations versus cash allocations. And finally, most importantly, the liquidity backdrop is terrible for stocks right now. So combination of central banks are continuing to tighten. You have inflation is still elevated and growth, it will slow, but it's still relatively high. It means that the excess liquidity in the system is still very low. And it's very difficult for stocks to rally with that backdrop in a sustainable way.
And Simon, when we're looking for clues about global growth, you focus in on Korean exports, often cited as a good barometer. What is the message that they give you?
So they're continuing to fall. So if you look at the growth rate of South Korean exports, they have basically collapsed. And they're a very good barometer because South Korea is a small, open trading economy. And so it's very kind of sensitive to the kind of like the global cross currents. And you see a very clear relationship. When you see things like South Korean exports falling, US earnings tend to do badly. And obviously with US earnings and price earnings ratios as well remaining low, it's a very difficult backdrop for equities to really have a sustainable rally.
Simon, thanks very much. Thanks for your time. Simon White joining us there with the latest on the markets, his view for stocks in 2023. And for more market analysis, check out the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal to keep track of the thoughts of the Markets Live team. This is Bloomberg. is Bloomberg Surveillance Early Edition. I'm Anna Edwards in New York with Danny Berger in London. Now, keeping you up to date with news from around the world, here's the first word. A crucial vote today in the House January 6th committee. Members will decide whether to recommend that former President Trump be prosecuted for obstructing a government proceeding and conspiracy to defraud the U.S. Bloomberg's learned the panel is also considering a charge of insurrection. The British Prime Minister Rishi Sunak will announce a major new artillery package for Ukraine today. The UK will supply hundreds of thousands of rounds of artillery ammunition next year. Sunak will be in Latvia to discuss Ukraine with his Nordic, Baltic and Dutch counterparts. Bloomberg's learned that FTX co-founder Sam Bankman-Fried plans to drop his fight against extradition to the United States. He's been locked up in the Bahamas since last Monday when he was arrested at the request of US authorities. Bankman-Fried has been accused of fraud and other crimes. Danny.
Well, Anna, coming up, we're going to discuss whether or not this market can put the FTX drama behind it or if there's more pain to come. We're going to be speaking with Tim Grant, head of EMEA at Galaxy Digital. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Coping with COVID. China looks to jumpstart an economy battered by COVID-0 restrictions. Meanwhile, there's suspicion that Beijing is hiding the real number of deaths from the latest outbreak. Millions respond after Elon Musk asked Twitter users whether he should step down as CEO. Most of them say he should. And euphoria in Argentina. A country battered by sky-high inflation and political uncertainty celebrates a World Cup victory for the ages. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Anna Edwards in New York this week. Matt Miller is off today and Kailey Leinz, she's in, but she's going to be hosting the U.S. Close show later today, so we're letting her sleep in a bit. Anna, no rest for the weary in this market. Yes, equities in the U.S. and Europe might be moving higher, but it's hard to know how much to read into them, just given it is the run-up to Christmas and the rest of the holidays.
Yeah, it was such a busy week last week, wasn't it, Danny? And so a lot of questions now about how much volume we'll have as we run towards the holidays and towards the end of the year. Of course, interesting and strange things can happen during low periods of volume. So we certainly don't take our eyes off the market. For the moment, then, this is what we see on S&P futures, up by 0.5%. Last week was really intensely negative by the end of the week. Really spooked by, well, Christine Lagarde perhaps rather than Jay Powell, but a focus on central bank tightening, certainly front and center for investors. Perhaps they've been wrong-footed into expecting too much from that Fed pivot or central bank pivot earlier on in the week, and so as a result we saw weakness. So we look to bounce a little bit from that. What does the year ahead hold for bonds? A big conversation in markets right now. This year has been bad for stocks, bad for bonds. Will next year be better for bonds if we're focused increasingly on recession fears? We've got the WTI price at $74.89. This in focus because the U.S. committing to buying up more crude for its strategic petroleum reserve. Also the China story in the mix here. China saying at its work council over the weekend it will focus in on growth. That didn't boost Chinese stocks, but maybe adding a little bit to demand for crude. And we've got Binance Coin in here as well. We often talk about Bitcoin on the program, but we thought we'd put Binance Coin in after this particular coin has seen a couple of days of strength, up around 6% or so, maybe more than that now, in the last two trading sessions. So Binance Coin looking to turn a corner perhaps from some of the volatility we've seen in crypto and the selling of crypto assets since the FTX scandal. More on that shortly in the program. Let me show you what's happening in the movers then. Pre-market here in the US, Tesla is up by 4.6%. So if the boss of your business has been incredibly distracted doing something else, and by that I mean Twitter over recent weeks, then no surprise if he asks Twitter, should he stay or should he go? If Twitter users are leaning towards him going, no surprise that perhaps puts some upward pressure on the Tesla share price. Will they get Elon Musk's full and undivided attention? Well, at least a fuller attention. Novavax, the biotech business, that stock up by 0.7%. There's been some focus on, most recently, on what's going on in the UK and the capital raise. That was last week's story. Today, a focus on what's been going on in Germany, an expanded recommendation for the COVID-19 vaccine there. And Amazon in focus, not moving all that much, but a focus on unionization. And as we head towards a European sort of winter of discontent when it comes to the level of strike activity, this ties in with that story. Amazon hit with a strike campaign in Germany just days before the holidays then, Danny. We'll have to see where this one ends, but increasingly unionized, the Amazon business on both sides of the Atlantic.
Well, Anna, here in Europe, it's really all about energy. Much like you were showing in the U.S., on a headline benchmark level, we are higher by about 0.7%. But underneath the surface, there isn't too much movement except for energy stocks. Those, as a sector, are up by more than 2.5%, just because perhaps oil is doing better today with China's new economic goals, with the U.S. refilling their SPR. But otherwise, it's continuing to be a story of a bond market sell-off in Europe. Europe is still underperforming that of the U.S. In Germany, 10-year yields are up by 3.5 basis points. Front end of the curve not moving too much, but it's still hanging around the highest level since 2008. It's that hawkishness coming from Christine Lagarde and the rest of the ECB policy members there, just saying that we need to keep moving higher, more 50 basis point hikes. Get a pivot out of your mind. The market is listening. They are pricing that in. Now, that is also helping the euro. The euro is strengthening versus the dollar. The dollar is down most of G10 currencies today. But again, it's that shrinking in the spread between European bonds and the U.S. that is giving the lift to the euro. Also, getting a lift versus the dollar is the South African rand. It's appreciating versus the dollar by about 2.5%. The ANC, the ruling party in South Africa, has re-elected Cyril Ramaphosa as their leader. There was some question as to whether that would happen. There was some question as to whether Ramaphosa would step down over a scandal that erupted from some stolen money that hadn't been reported. But with him firmly getting that re-election, yes, a countrywide election is coming in the coming years. But, Anna, I think that there's some more positivity from investors that perhaps this clears the way for him to continue to pursue his reform policies.
Yeah, interesting story, a fascinating story, in fact, Danny. And you mentioned what's going on with the dollar. I should also mention that the dollar against the yen is an interesting one to watch as well. Up by 0.4% on the Japanese currency as a result of a lot of speculation as to whether we'll see a change in the yield curve control policy coming through in Japan. We've got a BOJ meeting this week. So as we work towards the end of the year, that could be a focus for market attention. Let's get into a conversation about markets then now with Ben Gutteridge, Director of Model Portfolio Services for Invesco, who joins us on set in London. Ben, very nice to see you there in London. I want to take us to your overall view then for 2023 and for stocks. Michael Wilson over at Morgan Stanley says that US corporate profits are set to experience a drop like the 2008 era. And a lot of voices are talking about how expectations for profitability are too high when we head towards what looks to be a recession. What are your expectations for profits and how that plays out for stocks?
Well, I don't expect it to be a particularly rewarding period for earnings. You would assume that they would be coming under pressure. I think it's all about whether the market can sort of look through the valley of weakening earnings on the back of more accommodative monetary policy and the prospects for recovery as we move into the sort of second half of the year. No doubt investors should be sort of steeled for volatility as the earnings endure some downgrades. But although we didn't see it last week, if we do start to see some more softening from the Federal Reserve, then perhaps markets can deal with that earnings weakness.
But do you really expect the Fed to start softening? I mean, the labor market has squarely been the new focus of Powell, of everyone else, and it's not showing cracks.
No, it doesn't seem immediate. You're right. But I think what we can observe from this Federal Reserve is that it will change its approach if the data requires it. You know, just as it didn't expect inflation, soon all of a sudden it became much more hawkish. If we were to see, let's say, a third print of inflation weaker than anticipated, something of a downward trend, then we could see that softening. But you're right. I think the labour market will be crucial to that. But even there, you know, we might be seeing weakness in initial jobless claims, or off the highs at least. So there could be some evidence that labour markets are cooling, but you probably would need to see that to see like a dramatic softening in language, yes.
Well, it's still some uncertainties, and because of that, it does feel like there's still the strong demand for cash from investors, perhaps because cash-like instruments actually yield something. But Ben, I love you, right? Investors may not want to get too cute with their timing. I really like that. What does it mean not to get too cute right now?
Well, look, I think we're all, I don't know if it's sort of World Cup fever, but we are seeing this sort of game of two halves type setup, in that we've got weakness to come, we've got hawkish central banks and earnings downgrades, but that type of the recession needn't be too dramatic. Because there's not lots of imbalances. You know, consumers aren't in too bad a shape relative to history, banks in good shape. So the recovery could be quite a strong one, and so that could be rewarding for investors the second half of the year. So bearish now, bullish second half. But, you know, you sort of try and time that. It can be a very sort of emotional and less rewarding place. I think...
Much like the World Cup.
Much like the World Cup for most people. I think the strategy, or our preferred strategy, is just sort of be prepared to wear the volatility, but then fully participate in the recovery should it come in and around that second half.
OK, I don't know if you're casting the equity markets globally there, Ben, as the Argentinian team, but maybe that parallel works. Let me ask you about the extent of recession that you expect to see then, Ben, because if we do see a milder recession, isn't the negativity of that outcome that we just get more hiking from central banks? It seems difficult to find a positive way out of this unless inflation really did come crashing down.
Yeah, I mean, I think a recession is not anticipated by everyone, but it's certainly widely discussed. So I think those recessions that catch investors off guard are probably more damaging than those that are more broadly participated, but more broadly expected. But you're right, there is less room for the Federal Reserve to be overtly generous if inflation is still above target and economic outcomes are only relatively weak. But, you know, I think in a mild recessionary environment, coupled with the base effects that we're seeing from inflation and all those other things that are starting to see inflation move off its highs, you know, as we get into sort of the middle of next year, it could be that the Federal Reserve are pausing and that growth is recovering, and that could be, you know, enough of a mix to see equity markets enjoy a bit of recovery from that moment.
Ben, what do you expect to see in credit markets? How invested do you want to be in credit markets, corporate credit in particular? A lot of people point to the spreads we see at the moment and say these are not spreads that look as if they're preparing for a recessionary environment. Where does that leave you?
Well, I mean, spreads have certainly come in a little bit. I would have said, just a few weeks, maybe a month ago, that actually those spreads probably were preparing for a recessionary environment. Now it's a little more marginal. But I think much like equities, spreads will have investors in credit will have to endure some volatility until we see more firm commitment from the Federal Reserve, which doesn't seem imminent, as we've discussed, but mightn't be too far away. That they're softening their approach, and in that environment, you know, you expect sort of the duration element as well as the spread element to reward investors, and that, I think, on balance, sort of sets credit investors up reasonably well for 2023. Although, again, you know, could be a bit nervy in the early parts of the year.
OK, yes, very much like that World Cup final. Then we're back to that. Ben, thank you very much for joining us. Ben Gutteridge of Invesco on set with Danny there in London. Coming up on the crypto front, we will talk to Tim Grant, Head of EMEA at Galaxy Digital. Really great to get his perspective on the latest FTX news flow, of course, but also about institutional adoption of Bitcoin, of blockchain technology, where risk management for the sector goes post FTX. All of these things very topical. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with former New York Fed President Bill Dudley. That's at 8:30 a.m. in New York, 1:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in New York with Danny Berger in London. Now, Sam Bankman-Fried is said to be planning to drop his fight against extradition to the United States. Sources tell Bloomberg that the disgraced FTX co-founder is expected to tell a court this week that he won't fight the request. He's currently being held in prison in the Bahamas. Let's take stock of where we are post-FTX in the crypto story and blockchain story. Tim Grant joins us, Head of EMEA at Galaxy Digital, on set here in New York. Very good to see you here, Tim. Let me ask you about where we are on the risk management conversation, because whilst we've seen testimonies around what happened at FTX, a light has been shone very brightly on a lack of risk management at that particular business. I mean, we heard talk of accounting being run on QuickBooks and Slack being used for expenses. I mean, how does the crypto world, I suppose, distance itself from those kind of practices and say, that was just FTX, we do things differently?
Well, there are two elements at play here. I think when you look back at last week, the coordinated action by the Department of Justice, the SEC, the CFTC, the FBI, tells us that they think they've got some credible evidence to suggest that this is the bad actor that we all think he is. And that's now in its box, and we should all just move on from this. Let's let the process play out. We're dealing with a huge bad actor and a very naughty boy. Let's just move on. But there is this element of, well, how was it run, and how is the industry run? And I think that is the right question now. I think one thing I've been saying recently is there's no such thing as crypto economics. There's just economics. There's no such thing as crypto risk management. There's just traditional risk management. And I think those institutions that are demonstrating robust, transparent risk management with people at the helm who've been through multiple cycles, who know how this works, will be the ones that the institutional adoption cycle kind of prefers to go towards.
Okay, and when you're talking to large institutions, more traditional finance, I suppose, and you tell them those arguments, do they accept that FTX was just a special case? Risk management in the crypto world is done more professionally elsewhere?
Well, I think in some respects, this coordinated action last week has done us all a favour. It's shown that it was very quick, it was very swift. So it's pretty black and white. These guys have just been a bad actor. That's not so much about a pervasive issue of risk management being done in the wrong way or with lax standards across the board. Yes, it means we want more transparency in general, and trust is the name of the game here. Our institutional clients understand risk management, and they understand good and bad risk management when they see it. Look, when you look at the FTX situation, there's so many high-quality players were duped by this story.
Yeah.
They also understand risk management, but that's what bad actors do. They create a veil, and it's hard to pierce through. It will now accelerate the need for our institutional clients to ask the right questions and get the right answers, and that's to be welcomed.
Okay, Danny.
Tim, great to talk to you. Danny here in London. Are those institutional clients getting the right answers? We learned that Mazars, the French accounting firm, is no longer going to be doing these proof of reserve practices for the Crypto.com, the Binance of the world. Are you and your clients confident in these exchanges?
Well, we're all on a journey here, Danny. We, being a large market maker around the world at Galaxy on multiple exchanges, we've pulled back. And when we're part of that liquidity drop, you were talking in a previous segment about the lack of liquidity in markets in general, it's no different in the crypto space. And part of the reason that we've pulled back out of these exchanges is we want also to demand the level of transparency and trust that we want to be comfortable with. We have an exchange risk committee, just like any other grown-up traditional institutional player. Now, proof of reserves is a fascinating concept. It's actually been around for quite a while. And there's an interesting tidbit here that your viewers may not know. OKX, which is one of the larger crypto exchanges, actually produced a proof of reserves metric several years ago. And the CTO at OKX at the time was Chengpeng Zhao. It's the famous CZ who's now the CEO of Binance. So he knows a thing or two about proof of reserves. The key with proof of reserves is it has to be robust. It actually has to be cryptographically robust, cryptographically provable, and it has to have both the assets and the liability side in there so that we understand both sides of the coin. The challenge is we haven't reached a standardization of that metric. And Mazars, their public statement was they're worried about the public's perception of that metric. And I think we're sympathetic to that. We need to get to evolve to a state where that proof of reserves metric is well understood. We want to see the big four ultimately coming into this, and we know that they're sniffing around the space. So we're on a journey, Danny. We'll get there.
So if you've pulled back in the meantime, where are you instead? What are you doing instead if you've pulled back from some of these exchanges?
Yeah, it's a great point, actually. You know, we have multiple businesses at Galaxy. We're not just trading, and that's an important role that we play in the marketplaces, but we're also doing principal investing, we're doing banking. And one of the things that we're focusing on, we're actually seeing our institutional clients focus on, is looking for the builders, looking for those projects and those entities that are really demonstrating where this next phase is going to go. And on top of the risk management element that we were just talking about, the trust and transparency element, people just want robust business models. They want value creation in a way that we can understand with traditional metrics and fundamental analysis. Sure, there's lots of new elements we need to learn with this new technology, these new tools, but at the end of the day, remember, there's no such thing as crypto economics. There's just economics. And so money's still investing. I was just looking yesterday at some of of the trends over the last month. It's been a very quiet month, but you're still seeing good projects get rewarded with good investment. And I think that's going to be the name of the game while we're in this sort of low volatile, low liquid situation.
All right, so focus on the builders. Tim, thank you so much. Thanks for coming to see us so early here in New York. Tim Grant of Galaxy Digital. And tune in to Bloomberg Crypto. That's tomorrow at 1 p.m. New York time, 6 p.m. in London. The weekly show, co-hosted by Matt Miller and Kailey Leinz, covers the people, transactions and technology shaping the world of decentralized finance. This is Bloomberg.